Hi investor, if you're watching this video, you must be looking for the index fund or the ETFs or like a mutual funds. In this video, I will show to you what's the difference between mutual fund and ETFs, and when you select the ETFs, what are those risks and why we need to pick up the index fund. And actually, I'll also show you from the using the spreadsheet how over time our returns, 100% returns we invest, but we only get like a 40% the return only back from our 100%, because 60% mostly those active management fund which are not index funds, because of the fees, is eaten by the cost. So without further delay, let's get started. Okay, so here I'm on the Vanguard website. So here I'm purely focusing on the Vanguard funds because they are quite reputed in the industry to provide the low cost index funds. But before we go, I'll just so you might heard the term, okay, the mutual fund or the ETF. So let's get started with ETFs, right? So what is ETF? ETF is very popular now these days. Basically, what is an ETF? It is an exchange traded fund. So for example, either New York Stock Exchange, or in Toronto we have TSX, Toronto Stock Exchange and all, and that's stand for the ET. And the fund is basically the tens or hundred or sometimes thousands. So basically those are called the funds, right? Whether it's the stocks or bonds underlying that compose inside that ETF. So pretty much that's, you think as like a basket. If you have a basket of fruits or basket when you go in the market and buy the fruits, but in this case you have the basket of either stocks or bonds, depend how your ETF is composed of, rather than of a single stock, right? I do have a full video in my channel also on describing what is Dow Jones or what is S&P 500. If you even don't know that, feel free to check it out. Okay, why ETF is why we do ETF rather than individual stocks or bonds? One of the main reasons people are going toward ETFs is, or investors are going toward ETF, is because if you don't know, for example, accounting, right, then maybe you this doesn't mean that it's anything wrong in that, but that's a language where the financial statement written, and if you don't know that, then this means major negative points. And that's one of the reasons. And that's not what I am saying. That's what even mentioned by Charlie Munger in one of his book as well. So this is the book. So he said that, or whether you don't know, whether you don't do that, even you know accounting, but you don't do on the regular basis the investment or picking up the stocks, because people are busy in different kind of jobs, right? That's also I find it's mentioned in this lovely book. This book is on the little book on the common sense investing by John Bogle. Basically, he's the CEO of Vanguard. I'm not anywhere associated with this, but I like to read different kinds of books and see people opinions. Although from my background, I'm a CFA charter holder and FRM certified, and so I know the concept and all, but I just want to give you that these are mentioned by the quite a big investor. If I keep those aside, right, those are like a qualitative aspects of it, that whether even we have studied, but we are doing the different job, but this less risk on ETF. Why less risk? Because if you pick a single stock or two stocks, there is still a risk associated with it heavily, because let's say you put 50% in one stock or 50% in the, so 100%. But here the ETF composed, for example, I'll give you in the later video, where if your ETF is basically following the index, let's say S&P 500, it has 500 stocks, right? So basically you are following the market, so it's a less it's a less risk there, and then is a less work, right? Because you leave that selection to the fund manager, and actually the one of so that's less work. You don't have to pick the stock by yourself, so that's mentioned here. Now now we have covered, okay, what is an ETF and what is an why is we pick rather than individual stock and bond, right? Now another thing is why not mutual fund. So basically the concept is same. In mutual fund also you have a basket like of stocks, and ETF you also have like a underlying is a stocks or bond. The concept is same, but the advantage of using the ETF is you can start with very low investments, right? That's the key advantage. Second time, it just act like a share. You go and buy anytime, and you can buy anytime as a basket, right? Rather than you have to go to book an appointment with the fund manager, go to the bank or whoever is your brokerage is, and go and say, okay, I want to buy the mutual fund in small categories, right? So that's it. So I think yeah, ETF on that side is quite an advantage there, honestly, as well. And so that's it. So let's see some of the examples, right? Okay, so let's see if you want to so if there are many different kinds of ETF available. So if you go, I'll put this a link in the description below. And anyway, I'm not anywhere associated with this Vanguard or all. This is just purely education video. So yeah, so Vanguard ETF, if you go here and then they say, okay, the underlying, you can buy the ETF of treasury bonds. Basically, you know, the treasury bonds are issued by these US government, right? So it can be on either the short term or pretty long term, right? Or maybe the corporate, right? The bond as well, investment grade bonds. So there's all kind of varieties there. So these are just a few, the tax exempt, or even on the stocks, right? The large cap stocks, mid cap, some are following Russell index, or this is quite famous, the S&P 500 ETFs, WOO, the ticker is WOO. So basically how you go and buy this, you just simply go to your brokerage open account and then just type this ticker and just buy like any other stocks. But now the question is why, and there are so many varieties you can invest in, let's say in China or some active, there's so many varieties there. But just a caution here, now when people say, and you might heard a lot, okay, invest in low cost index funds. Why so, right? Why not just invest where we'll get a heavy return and then we don't have to pay much cost as well, right? I'll show you this with the example, and actually this is eye-opening for me. I never thought, usually from the power of compounding, I always thought from the return perspective, but this can be very negative, the power of compounding, when it comes out to as a cost, right? So let me show that, bring that sheet to you. But before I do that, I'll request, if you haven't liked the video, please do like it now, or subscribe to the channel. It really helps me to motivate this, to make these kinds of video. Okay, so what I'm showing here, so here I'm showing one of the example. So basically I took the example from the same this book, but rather than having in the original example on the page, it's take a 7% return, I think, which is quite old now these days, and the fees is taken 2%. So I just change the 7 to 15%, but the example pretty much reflect the same. So basically what it's saying, the time period or the holding period, as you can see, is a 50-year, right? Which is as per the author is quite normal. If you start from, for example, you get your job at 21 years, and then you invest, you just invest, let's say one time. I'm not just cumulative invest, and the holding is you just hold that for, let's say, for 50 years, right? So that's just a little bit extreme, but that's not too bad. And then let's say you get 15% return, right? And you say, okay, for 15%, and then you charge, say, the expense ratio. Basically these the funds, they charge the expense ratio cover like the management fees, buying and selling, transaction, and also let's say on that it's covered, let's say 2 or 2.2. Most of the active funds charge 2%, right, or 2.2, or some are even charging more. I'm just taking a general fees here, and then they can say 20%, or I'm just conservative saying, okay, let's 20 or 15, whatever, right? And the net fees is, let's say, is 13%. If our holding period is 50 years, you can see here the $10,000 invested and then just leave it, right? Here, initially there is no difference, right? We cannot see the fees, but look at after 20-25 years, right? So the total return should be around coming as 10, with 15% return coming as 10 million, right? Look at this, coming as 10 million. But how much we are getting? We are getting only 4.5 million. Why? That's the power of compounding, because this 6.3 million, you believe it or not, it's taken it by the fund fees. So that's the worst case, right? So basically we invested the 10,000, that's our own investment, but that's what the author is trying to say, that we only get like a 40 or near 42% in this case, but almost 60% goes to the cost, which is weird. So that's one of the reason author and the market and I'm making this video as well, to invest in the index funds. If somebody doesn't want to invest in the stock, to at least save this kind of a cost, this much from the cost as well, right? So I'll share one or two the quite popular index funds. So basically, if I'll see here the S&P 500, basically this Vanguard S&P 500 is what it does. It basically tracks the S&P 500 index, which is composed of 500 largest stock, right? And the good point here is it only charges 0.03% fees. So for every $10,000, only $3. So which is very less, right? And if you can see from so usually this is from the same website. I'll put a link. If you invest $10,000, it's under 20, it's already $37,000. So it's very closely, if you see the S&P 500 and S&P 500 index, which is the original index, the ETF, it's very close in terms of the dollar value and percentage. So that's a very good sign, right? Now, what is this index composed of? For sure, this index, you don't have to invest in all other stocks. So this is this 10 largest stocks there in this ETFs, which is Apple, Microsoft, Amazon, Alphabet, Facebook, Berkshire, and all, right? And these are the sectors which S&P 500 is invested. So right now the fund, right? So the total number of asset is 620 billion right now has the value of this fund. So look at this, the power, so much money is in this fund. Another one is also very popular is VTI. VTI is the total market index funds, and in this one again it's covered the overall the broad market index fund, and this is also 0.03 and feel free to check it out. For the Canadian investors, I just want to point out one, and in this if you go to the Canadian website, actually here I'm already here, and then you can go, I'll show you the difference. There is a S&P, if you want to invest in the S&P 500, there is a VFV ticker for Canadian. But I just want to show you one thing. This is the fees here, 0.08. Come on, give me a break. Why somebody wants to pay even 0.08 when we already know the same fund, if you just do a spot translation just one time and convert your money in US dollars and then only pay 0.03. So these kind of a common sense, if you do, in the long run, we'll save a lot, as we learn here right? So rather than, so it's just a one time, but on the long run, it saves a lot. And for sure, it also has like a local TXS and other funds. If you want to select, feel free to check it out. So that's pretty much I would like to mention in this video, right? So I think the goal here is not to beat the market. If you're going towards the stock, there are, and similarly you can also have like maybe 60 or 40, depend upon how much you want to do invest in stock, but feel free to invest in, let's say, the intermediate terms, the bond, right? Just also the bond as well, right? It's because these are all low and the long-term bond index. So look at the yield, it's giving 15% yield as well, right? So it's up to this year. So, and also the 10-year is 7-8%, so it's not bad. So this is BLV. This is the, what is this? This is the long-term bonds, Vanguard bonds. Maybe it tracks, as long as it tracks the corporate, or yeah, so it's tracking the investment grade bonds fund. So that looks good as well. So yeah, so that's pretty much on this video. I'll try to not only show, but just want to show with the example that this can be happen. Yeah, feel free to comment it out if you have any specific question. I love to answer your questions. If you don't understand any other topic, I covered the PE ratios and index funds and other, but usually I do the stock valuation in my channel. Yeah, and if you want me to cover any other video, please put in the comment and I'll cover in the next videos for you. And yeah, thanks for watching and bye for now.